From January to May 2022, both stocks and cryptocurrencies declined significantly, and everything was getting a lot more expensive. We may be entering a bear market, but there is a way to predict when stock prices may rise again. Stocks are down 20 to 30%. Bitcoin is down 40%. Interest rates are rising. Inflation is high. Real estate prices and rents are skyrocketing. COVID-19 is still around. Where is it all heading? Some people say that we are heading into a bear market. Maybe we are also heading toward a recession. The Federal Reserve is trying to tamp down inflation by raising interest rates, but it may cause a recession if interest rates are raised too quickly or too far. When people fear the future, they hold on to their money. They avoid risky investments. They restrain their spending. They do the types of things that will cause the very thing they fear. Many people are afraid because they are not sure what is going to happen. When will things get better? There is a way to predict the future to some extent. Understanding what causes systemic risk will help to mitigate, avoid, or even profit from this risk. Understanding the causes of systemic risk helps to forecast when it may start and when it may end. There are many types of risk that are caused by different factors, or which affect different investments to varying extents. Some factors affect most investments and are called systemic risks, sometimes called systematic risks. Other risks are more limited in scope, such as sector risks that affect only a particular sector of the economy, or specific risks that affect particular businesses or assets. Most financial risks can be minimized by diversification, buying different types of assets that are not closely related. However, some risks cannot be minimized through diversification. The key to minimizing losses because of systemic risks is to predict when such risks are increasing. But how do you know when such risks are increasing? Some market gurus try to predict the bottom through financial analysis. However, this does not work because the causes of systemic risk are not based on overvaluation. Overvalued assets may decrease in price faster when systemic risk increases, but even undervalued assets will decline in price. This chart shows the trailing 12-month S&P 500 PE ratio, or price to earnings ratio, back to 1926. As you can see, the PE ratio has varied widely as long as stocks have been around, so market bottoms cannot be predicted through financial analysis. A primary cause of systemic risk is an increasing desire for money. People do four things with money: invest, spend, pay down debt, hold money to protect against an uncertain future. The main reason for holding money is that people anticipate spending it soon, or they are too afraid to invest it at that time, since they may be forced to sell at a loss if they need the money to spend. Holding money includes keeping it in a savings account or checking account, money that can be used to pay bills or be quickly converted to cash to spend. People only have so much money. Therefore, if people decide to spend more, or are forced to spend more, then the amount of money invested declines and more assets are sold. Less buying and more selling means the prices of assets will decline. The amount of this decline will depend on how much money people want to spend, to pay down debt, or to hold. I will first illustrate this central idea with a simple example, then extend this idea to explain the current situation. It has long been observed that stock prices tend to increase the most from November to April, then from May to October. This seasonal pattern has been observed for decades. Why does this seasonal pattern occur? I propose that the cause of this seasonal pattern is that people want to spend more money in the summertime and early fall. They want to travel. They want to buy real estate. They want to get married. They need to pay for school expenses in the fall. These items cost a lot of money, so they need more money. A natural way to get this money is to sell some of their assets, such as stocks. This would explain why the stock market does not do nearly as well in the summertime and early fall as it does during the rest of the year. The COVID-19 pandemic brought many changes to the world economy that forced people to spend more money. When the pandemic started, businesses had to close or reduce activity. People lost their jobs, so people had to sell assets to keep paying their bills. Almost all assets, including stocks and cryptocurrencies, plummeted in value. Bitcoin was even below $5,000 at one point. The economy quickly rebounded because the Federal Reserve greatly increased the money supply, and the government sent cash to people and businesses so they could survive. But now the Fed is tapering and raising interest rates, and the government is no longer sending free cash. This chart shows the dramatic changes in the S&P 500 when the need for money changes dramatically. You can see when the COVID-19 pandemic began from this chart of the S&P 500, when stock prices plummeted, as can be seen in the gray shaded area. You can also see the dramatic rise in stock prices afterward when the Federal Reserve lowered interest rates to zero and the federal government started giving both businesses and people stimulus payments to help them survive. Since they had to stay at home, people couldn't spend their money, so they invested it. Inflation has increased because of low interest rates, a much greater money supply, the Russian-Ukrainian war, supply bottlenecks created by COVID-19 pandemic and the Russian-Ukrainian war, and COVID-19 lockdowns in China. Whenever inflation spikes, the Fed raises interest rates, which often leads to a recession, as you can see in this chart of inflation since 1960. This is an expanded view of recent times. As you can see, inflation has risen sharply, topping 10% in some areas of the country. Inflation makes most things more expensive, so people need more money just to live. People were spending their money saved during the pandemic to enjoy the summer in 2022, better than the previous 2 summers. Many people want to travel, which will keep prices elevated. Housing prices were jumping because people wanted to buy a home before interest rates rose further. Supply bottlenecks were persisting longer than government officials predicted, keeping inflation high. The Russian-Ukrainian war worsened the supply chain problems. Higher interest rates will depress both stock prices and cryptocurrencies. Debt becomes more expensive, so assets may be sold to lower debt. People will use less leverage in investments. Less buying, even if selling remains the same, will lead to lower prices. Reduced asset prices will trigger margin calls. Many people will choose to liquidate their positions amidst uncertainty. More money will be transferred from stocks and other risky assets to safer assets paying interest, especially treasuries. Housing prices will decline. Here, you can see more clearly how very low interest rates in the past 12 years have sent stock prices skyrocketing. Higher interest rates do not always depress stock prices, but they always have a negative effect, even if that effect does not predominate. This chart better shows the sharp decline that occurred in the last 3 months of 2018, when the Federal Reserve was quickly raising interest rates. But the stock market recovered in early 2019, when the Fed indicated that interest rates would not be raised further. The forward guidance provided by the Federal Reserve stipulates that interest rates will continue to rise at least for the next year or so, possibly by half a percentage point increments. Because interest rates are rising, people are desperately trying to buy a house before rates rise further, leading to a bidding frenzy. This spikes the price of real estate. Cash buyers have an advantage in the market, but even people who are borrowing will sell assets for the cash that they need. This depresses other asset prices. Bond prices also decline with higher interest rates, since there is an inverse relationship between bond prices and interest rates. Longer-term bonds have higher interest rate risk. More bonds will also default because higher interest rates depress sales and makes debt more expensive. However, treasuries may benefit since they have no default risk and may benefit from a so-called flight to quality. Often, economic booms and busts occur because of the debt cycle. When things are good, people become more confident. They borrow more money. This stimulates the economy, causing it to heat up. The Federal Reserve responds by raising interest rates, which makes debt more expensive. Eventually, the debt must be paid back, so the economy slows, which may lead to layoffs. This causes the economy to contract further. Then the Federal Reserve repeats the cycle by lowering interest rates, but no matter how low the interest rates are, it still takes time to pay off debt, requiring most people to spend less. A good illustration of this is the Great Recession, which started in 2007. Banks lowered their lending standards because they could package their loans into mortgage-backed securities and other asset-backed securities, then sell them to investors, thereby offsetting their credit default risk. Because they earned most of their money from loan origination fees and by servicing the loans, and didn't have to worry about credit default risk, they made more money by offering more loans, so many of the loans went to subprime borrowers who bought houses, driving up the price of real estate. Housing prices soared, so many people used their home equity to borrow more money, which quickly stimulated the economy. The Fed quickly raised interest rates, making debt a lot more expensive. Subprime borrowers started to default. This caused the holders of the asset-backed securities to also lose a lot of money, which further contracted the economy. As the economy contracted, business declined, leading to many layoffs. Although the Federal Reserve lowered its interest rate to near zero, it didn't help people with high debt and no job. Although the amount of debt has been climbing, the credit risk is not nearly as high as it was during the Great Recession. Nonetheless, higher interest rates will make that debt more expensive, so people may sell their assets to pay down their debt, which will depress asset prices. Investments will rise and fall in the short term, just as they have always done. However, an upward trend will not begin until inflation is subdued and interest rates stabilize. During the summer, people will be traveling, and in the fall, many people must pay for school expenses, so the financial markets probably will not rise significantly until October. By then, interest rates will have risen high enough to cool off the housing market, so the selling of assets to buy real estate should decline markedly. Interest rates will still be high in the fall, and will probably still be increasing, so the stock market will only recover slowly in the fall. The stock market will not rise nearly as fast as it did during the COVID-19 pandemic. Whether cryptocurrencies will recover is more difficult to forecast, since with an intrinsic value of zero, their prices depend more on hype, although economic factors do affect their prices. Higher interest rates will also depress cryptocurrency prices. Another factor that may depress cryptocurrency prices is the development of government-issued cryptocurrencies, since people have greater trust in their own government. Government-issued cryptocurrencies will have the advantage of providing seigniorage to the government, which helps to lower taxes, and can be used to affect monetary policy, which cannot be done with private cryptocurrencies. A better understanding of the economy makes predicting the financial markets more accurate. However, it is difficult to quantify economic variables, so any prediction will be necessarily a ballpark estimate. What will help to prevent or mitigate losses is to continually monitor the news, especially with respect to key economic factors concerning the financial markets. You should continually monitor interest rates, the inflation rate, total household and business debt, the unemployment rate, and what assets seem to be in vogue, and anything else that may affect people's desire to hold money. While many other economic factors can be considered, this increases the complexity of the analysis, but the simple factors listed above are widely published in many news sources, so they are a good way to get a rough indication on how well investments will do at that time, and 1 or 2 months afterwards. As of May 2022, things do not look too bad. Although the market has fallen quite a bit from the beginning of the year, the economy is still very strong and consumer debt is not exorbitant, so a recession is unlikely. Inflation should moderate as businesses figure out how to solve their supply chain issues. My prediction is that the stock market will meander during the summer months and early fall of 2022. By mid-October, I think the stock market will trend upward again, but with higher interest rates and a lower money supply, the ascent will not be nearly as quick as it was after the beginning of the COVID-19 pandemic. Thank you very much for your time. If you liked my video, please give me a thumbs up and subscribe. I would appreciate any suggestions, so please leave them in the comments below.